Imagine you are watching a stock that has been falling for several months. Every morning you check the price, and every morning it seems to be a little lower. Then one day, the market suddenly turns nervous. There's talk of a possible war. News channels become filled with uncertainty. Investors begin selling almost everything, and the stock you are watching falls another 15%. Now imagine that nothing fundamental has changed inside the company. Its factories are still operating. Customers are still placing orders. Management is still executing its plans. Its long-term opportunities are still intact. Only the atmosphere has changed. But your instinct tells you to sell. That instinct is one of the most powerful forces in the stock market. Fear does not need to destroy a business before it can destroy an investor's confidence. Sometimes all it needs is uncertainty. This is where one of the most important ideas in investing appears. The stock market is not only a machine for valuing businesses. It is also a machine for expressing human emotions. And when fear becomes extreme, the price of a good business can temporarily move far away from the underlying economics. Philip Fisher spent considerable attention on this kind of investor behavior. The challenge is not simply knowing that markets become emotional. The challenge is knowing what to do when everyone around you is becoming emotional. Imagine an investor holding shares of a company that supplies specialized equipment to industrial manufacturers. The business has been performing well. Orders are increasing. Management has been expanding production. The company has been developing new products. Everything suggests that the long-term opportunity remains attractive. Then international tensions suddenly increase. Investors begin worrying about what a major conflict could mean for the economy. The stock falls sharply. The investor starts thinking, what if the economy collapses? What if customers stop spending? What if the company loses its market? What if the situation becomes much worse? The fear feels reasonable. And that is exactly what makes it dangerous. Because reasonable fear can still produce unreasonable decisions. The first mistake is assuming that the market reaction tells you what will happen to the business. It does not. A falling stock price tells you that investors are becoming more pessimistic. It does not automatically tell you that the company has become less valuable. The next question should therefore be much more specific. What has actually changed inside the business? If the answer is that the economics remain largely intact, then the investor may be looking at something very different from a business failure. The market may simply be repricing uncertainty. This does not mean every market decline is an opportunity. Sometimes the fear is justified. Sometimes the business really is deteriorating. Sometimes an external shock permanently changes demand. The point is not to ignore bad news. The point is to separate emotional fear from fundamental damage. That distinction can become incredibly valuable during periods of extreme uncertainty. Because markets often move faster than businesses do. A share price can fall 20% in a single day. A factory does not become 20% less productive in a few hours. A strong distribution network does not disappear overnight. A valuable customer relationship does not necessarily vanish because investors are nervous. The market can change instantly. The business usually changes more slowly. That difference creates both risk and opportunity. But fear is not the only emotion that creates mistakes. Greed can be just as dangerous. Imagine discovering a small company operating in a highly specialized industry. The business has a promising technology. Its management appears capable. Its potential market is large. The stock begins rising rapidly. Suddenly everyone wants to own it. The investor who bought early begins feeling brilliant. The investor who missed the move begins feeling left behind. Now comes the temptation. Buy it anyway. The price no longer matters. The investor tells himself that the company is going to become much larger. And perhaps it will. But a great future does not automatically make every price attractive. The question is always, what are you paying for that future? Suppose a company could eventually become 5 times larger. That sounds exciting. But if the market price already assumes that transformation will happen, then the opportunity may be much smaller than it appears. The business can succeed. The investor can still earn disappointing returns. This is one of the hardest lessons in the market. Being right about the company is not enough. You also have to be right about what you pay. And this is where investors often become anchored to old prices. A stock traded at 500 rupees. Now it trades at 300. It feels cheap. But why? Because it used to be 500. That is not valuation. That is memory. The previous price may have been completely unreasonable. Or the business may have changed. Or competitors may have become stronger. Or future earnings may have deteriorated. The important number is not what someone paid yesterday. The important question is what the business is worth today and what it may become in the future. Imagine buying a piece of land. The seller tells you that another person offered 10 million rupees for it 5 years ago. Would that automatically make the land worth 10 million today? Of course not. You would inspect the land. You would look at its location. You would understand what can be built on it. You would study the surrounding area. And then you would decide what it is actually worth. Stocks deserve the same discipline. A previous market price is information. It is not a conclusion. This becomes especially important when investors look at long periods of past performance. Suppose a company earned 10 rupees per share 5 years ago. Then earnings increased to 12. Then 14. Then 16. Now the investor sees the historical growth and starts calculating what earnings might become 5 years from now. That can be useful. But there is a trap. The future is not simply a copy of the past. The company may enter a new phase. Competition may increase. Margins may change. The industry may mature. A major new product may succeed. Or it may fail. The conditions that produced the previous 5 years may not exist during the next 5. This is why historical numbers should be understood rather than worshipped. The past gives you evidence. It does not give you a guaranteed future. Now imagine an investor who owns 10 companies. At first this seems sensible. 10 companies feel safer than one. But then something interesting happens. The investor becomes comfortable. Every stock gets only a small amount of attention. A weak company remains in the portfolio because it is only a small position. A strong company also remains small because the investor is afraid of having too much money in one place. The portfolio becomes a collection of names rather than a collection of well-understood businesses. Diversification can reduce risk, but too much diversification can also create a different problem. You may end up owning so many companies that you no longer understand any of them deeply. Imagine a doctor trying to treat 20 patients at exactly the same level of attention. Eventually, the quality of attention becomes the problem. The investor faces a similar limitation. There is only so much time available for research. Only so many businesses can be followed properly. Only so many management teams can be studied. Only so many industries can be understood in depth. The goal should not be to own as many stocks as possible. The goal should be to own enough good opportunities while maintaining enough understanding of what you own. That does not mean putting everything into one company. Concentration without understanding can be disastrous. But spreading capital so widely that every position becomes insignificant can also reduce the benefit of having done serious research. The important question is not how many stocks you own. It is whether you understand why you own them, and whether the risks are genuinely different. Owning several companies may look diversified, but if all of them depend on the same economic cycle, they may behave almost like one investment. Owning businesses across different industries can sometimes provide a stronger form of diversification. But even then, the investor has to understand the individual companies. The objective is not to create a colorful portfolio. It is to create a portfolio where each holding has a reason for being there. There is another psychological trap that appears when investors try to compare stocks. A company may have risen sharply. Another may have barely moved. The investor assumes the second one must now be the better opportunity. But price movement alone tells you very little. A stock that has risen may have become much more valuable. A stock that has fallen may have become much weaker. The market price is only the starting point for investigation. Imagine two restaurants in the same city. One has doubled its customer base, improved its menu, opened new locations, and developed a strong delivery business. The other has lost customers, closed locations, and reduced its staff. If the first restaurant becomes more expensive while the second becomes cheaper, which one is actually the better business? The answer is obvious. Yet investors often reverse this logic in the stock market. They see a rising stock and think it is expensive. They see a falling stock and think it is cheap. But the business may have changed in exactly the opposite direction. This is why the investor has to keep looking underneath the price. There is another powerful source of confusion: short-term news. Every day the market receives a new story, a government announcement, a geopolitical development, a change in interest rates, a new regulation, a commodity price movement, a political event, an economic forecast. Some of these events matter enormously. Others barely matter to the long-term economics of a particular business. The difficulty is knowing which is which. Imagine a company that has spent years developing equipment for water treatment plants. The company has long-term contracts, specialized technology, strong relationships with customers, and a large installed base. Then interest rates rise. The stock falls. Should the investor automatically conclude that the business has become unattractive? Not necessarily. The higher rates may affect valuation. They may influence future investment. They may slow parts of the economy. But the investor still needs to ask what happens to the company itself. Does demand disappear? Do competitors gain an advantage? Does the company lose pricing power? Does its balance sheet become dangerous? Or does the business continue doing what it was doing before? The answer matters much more than the headline. This is why successful investing often requires resisting the urge to react to every piece of information. Not every event deserves a portfolio decision. Sometimes the smartest action is simply to understand what has changed and what has not changed. And this brings us back to the fear of war. When a major conflict threatens the world, markets can react violently. Investors may rush toward cash. Stocks fall. Currencies move. Commodity prices change. Headlines become frightening. It can feel as though selling everything is the only sensible response. But history repeatedly shows that markets can react far more dramatically than the underlying businesses. A war can change the economic environment. It can create serious damage. It can also change demand in different industries in very different ways. Some companies may become weaker. Some may become stronger. Some may experience temporary disruption. Others may see long-term structural change. The investor, therefore, needs to examine the individual business rather than treating the entire market as one object. And there is an even deeper point. Money itself is not immune to the consequences of major economic disruption. During periods of severe inflation, the amount of money required to buy the same goods can increase dramatically. So sitting in cash may feel safe. But safety has a price. If the purchasing power of money is falling rapidly, then the investor is also experiencing a form of loss. This does not mean cash is always wrong. It means every investment decision has to be judged against the economic environment. The question is never simply, what is safest? The question is, safe from what? Safe from falling prices. Safe from inflation. Safe from business failure. Safe from market volatility. Different assets protect against different risks. And that is why simple rules can become dangerous when applied without thinking. One of the most common simple rules is to look at what a stock traded for several years ago. Investors often remember the highest price. They remember the lowest price. They draw a mental range. And then they judge the current price against that range. But the company does not remain the same while the chart is moving. Management changes. Products change. Markets change. Competition changes. Profitability changes. The balance sheet changes. Future opportunities change. So why should the old price remain the central reference point? It should not. The correct reference point is the economics of the company. If a business is far stronger today than it was 5 years ago, then comparing today's price with the old price may be misleading. If the business is far weaker, then the same comparison can be even more dangerous. This is why the investor should not become hypnotized by charts of historical prices. The stock market is constantly tempting you to look backward. The investor has to keep looking forward. What will the business earn? What opportunities does it have? What risks does it face? How strong is management? How much can the company grow? How much capital will that growth require? And what future is already reflected in the current price? Those questions are much more useful than asking whether the stock has fallen from its previous high. There is another trap hidden inside financial reports. Investors are surrounded by forecasts, estimated earnings, expected growth, projected profits, future targets, analyst opinions. These numbers can create an illusion of precision. A forecast may say that earnings will reach a particular level next year. Another may predict something completely different. Both can be presented with confidence. But the future does not become certain simply because someone put a number on it. The investor should therefore treat forecasts as possibilities rather than facts. The more important task is understanding the business conditions that will determine whether those forecasts can become reality. If demand is growing, if capacity is expanding, if management is executing, if competition remains manageable, if the economics are improving, then the future may have strong support. But if the forecast depends on several assumptions, all being correct, then the apparent precision can be misleading. This brings us back to a simple habit. Ask why. Why are earnings rising? Why are margins improving? Why is the stock falling? Why is the market suddenly optimistic? Why is management investing? Why are customers changing their behavior? Why is the company gaining or losing ground? And when you think you have the answer, ask again. Why? Because the first explanation is often only the surface. The deeper explanation is where the investment insight usually lives. A falling stock may be fear, or it may be a broken business. A rising stock may be genuine improvement, or it may be excitement. A cheap valuation may be an opportunity, or it may be a warning. Diversification may reduce risk, or it may dilute your understanding. A historical price may provide context, or it may become an anchor that prevents rational thinking. A forecast may help you think about possibilities, or it may create false confidence. The investor's job is to distinguish between these possibilities, and that requires something more difficult than intelligence. It requires discipline. The discipline to avoid reacting to every headline. The discipline to avoid buying simply because a stock has fallen. The discipline to avoid selling simply because fear is rising. The discipline to avoid owning dozens of companies you cannot properly understand. The discipline to question forecasts. And the discipline to judge the business as it exists today rather than as it existed several years ago. Now return to that investor watching the industrial equipment company during the market panic. The stock has fallen sharply. The headlines remain frightening. Other investors are selling. But instead of immediately acting, the investor asks one question. What has actually changed? The company is still receiving orders. Its long-term contracts remain. Its management team is still investing. Its competitive position remains intact. The market is afraid, but the business has not changed in the same way. That does not guarantee success. Nothing in investing does. But it changes the decision. The investor is no longer reacting to the market. The investor is investigating the business. And that is the difference between owning a stock and understanding a stock. The market will always give you reasons to be afraid. It will also give you reasons to become greedy. It will constantly show you yesterday's prices, tomorrow's forecasts, today's headlines, and someone else's opinion. But the investor who can step back and ask what actually matters has an enormous advantage. Because a stock is not cheap simply because it once traded higher. A stock is not dangerous simply because it has fallen. A stock is not safe simply because it is diversified. A stock is not attractive simply because analysts expect higher earnings. And a market is not necessarily telling you the truth about a business simply because its price is moving rapidly. The price is visible. The economics are underneath. And when fear becomes loud, when headlines become frightening, when prices become disconnected from business reality, that is when the ability to look underneath the price becomes most valuable. Because every stock has a business behind it. Every business has changing economics. And every investor has emotions that can interfere with judgment. The real challenge is not eliminating fear or greed. It is learning not to let either one make the decision for you. When everyone is running toward the exit, ask what they are running from. When everyone is chasing a rising stock, ask what future they are already paying for. When everyone is calling a fallen stock cheap, ask what has actually changed. And when the market gives you a price, look underneath it. Because the price is only the surface. The business is where the real story is happening.